AI infrastructure stocks are some of the hottest stocks in the market right now. You've got the likes of Nebius, CoreWeave, and then people transitioning like Iron and Hive, and they are very, very hyped and talked about right now because money is flying all over within AI. So today I'm going to do a deep dive analysis on Nebius. This is one of my investments itself, but for a lot of people that want to learn about it, they want to learn more, so I'm going to do that today. Before we jump in the video, please be mindful that anything said in this video is not financial advice. It is purely for information purposes only. Please bear in mind that when investing, your capital is at risk and you are not guaranteed to make any money, and you could in fact lose all of the money. So what is the company origin of Nebius? It was previously the biggest Russian company, which was Yandex, and basically that is dubbed as the Google of Russia. But in 2024 they sold their AI and internet access for $5.4 billion to local investors, and they rebranded to Nebius in 2024, which is headquartered in Amsterdam and is managed by Yandex's founders. So a very good track record and history in this space. Moving on to their structure, they have a few subsidiaries. So if you look into them further, we have Avride, which is autonomous vehicles, and this is fully owned by Nebius, and they are signing quite a few contracts, so that looks very positive. The next one that they fully own is a company called Triple 10, which is a tech education platform, and that is growing quite well as well. And then the next two are companies that they've got minority stakes in. So first we've got Takola, which provides data for AI agents and model development, but this is also in partnership with Jeff Bezos and the CTO of Shopify, so some big investors there really. And then the other major subsidiary that they have, which they do have a minority stake, but it is at 28%, which is still a large chunk. This is ClickHouse, which is open source analytics database. So yeah. And then on top of this, they have launched a Nebius Robotics Award. I think it's going to be an annual award ceremony going forward. And really that's quite important because they could spot some key little robotic companies that they want to invest in or take a minor stake in, and really see that grow and see the benefits of that. So yeah, that's going to be interesting to see what comes of that, and if they do sign any more investments through that route. In terms of their subsidiaries and investments, the CEO said the following: that we expect these non-core businesses to grow significantly and will look to utilize as funding sources for core AI infrastructure. So they clearly see these subsidiaries growing that they can sell to fund more business activities. So if we take a look at Nebius's financial position, one of the key things to be aware of before we do look into it is they are very capital intensive right now. So they are spending a lot of money building these data centers, setting up the infrastructure, getting all the things in place to then manage the workload that they've currently got and to bring on more customers. So when we're looking through this, be aware that they are spending money, and they're going to continue spending money whilst they rapidly expand their data centers. But this is all for long run benefits. But yeah, it's quite common for companies like Nebius, who are in a massive growth stage, to be spending a lot of money to support that growth. Otherwise, they'll just hit a capacity. They won't be able to sign new customers, new clients, or massive contracts like the Microsoft one. So really they've got to show that ambition with growth to make sure it's going to be worth it. If we look at the Q2 report, revenue was 105 million for that quarter, which was up 625% year over year, which is impressive. If they keep growing like that, then we'll be very happy, but I do expect that to slow down. Annualized run rate of $430 million, so this is up from $249 million in quarter one. So that shows the annual revenue is constantly growing, which is brilliant. Adjusted EBITDA was minus 21 million. I just want to highlight this, but the gross margin is improving ahead of plan. So yeah, be quite interesting to see what the adjusted EBITDA is going to be in the next earnings, which is literally in 2 weeks. So this whole financial position could change. From what I can see, Gross margin sits around 55%, which is a very healthy gross margin. Once they stop all this capital expenditure, that gross margin will very easily be made into profit. So that's promising. There was an operating loss of 111 million, and if this continues, they will need further funding to support business operations and expansion. So just be aware of that when you are looking into Nebius yourself. And they recently raised $978 million of long-term debt to aid them in their expansion. So to summarize that, if you're not too good with finance, they are currently spending a lot of money, but they need to spend that money to support the customers they already have, sign new customers and deliver them contracts, and to grow the business overall, which is very common. But obviously capital intensive programs can be quite risky, because if it doesn't pay off, then they could lose a lot of money or struggle to pay back the debts. So just keep that in mind. But like I said, the next earnings is literally in 2 weeks after I'm recording this video. I think it's November 11th off the top of my head. So I'm quite looking forward to that, and it'll be interesting to see how they've done and if they are improving. So yeah, it's an interesting one. Just a quick one. I found out about this company through a Discord community that I'm in, that's run by Ben's Finance and Jay's Finance, and this was highlighted back to people in March, April, May time, when it was sitting between $20 and $40. Obviously, when I'm recording this, the stock price currently is $116. And this community is brilliant because everyone just shares all of their information, all of the due diligence, and you get to know a lot of stocks early. So if you scan the QR code on the screen, you can join that Discord. It is £5 a month, but for all the information you get and the community you get with it, it is totally worth it. So next, I want to cover their major contracts and the growth analysis. And there's really one major contract that everyone will have talked about, and if you haven't found out about it by now, we're going to dive into it further. And this is the Microsoft GPU deal. So in September 2025, they signed a contract with Microsoft that's going to run until 2031, but it's a 5-year contract, so it'll start in 2026. This is for GPU capacity, and this is dedicated Nvidia GPU infrastructure, which will be housed in their New Jersey facility, which is currently being constructed. So that's key. The price of this deal alone, bearing in mind the revenue for the last quarter was 105 million. The price for this over 5 years is $17.4 billion, which is insane. So if you take that on a quarterly revenue basis, from this contract alone, they are getting $870 million per quarter over the lifespan of this 5 years, and there is potential for it to rise to 19.4 billion. So if I go through that again, the last quarter they earned $105 million, and under this new contract alone, they're going to get $870 million in revenue from Microsoft. So that just shows how quick the financials are going to grow. Key thing to note with this though is if they do fail to deliver milestones, Microsoft can terminate that contract. So they must meet the build schedule or face losing this 870 million revenue per quarter. So that's quite substantial, but I don't think they would have signed this contract if they don't think they can't deliver that. So that's very important. Really, they've got the trust within the company to say they can deliver that. And this massive deal de-risks that expansion plan straight away, because they're spending all this capital money and they can already see the rewards of expanding and signing on new customers. So that's great. On top of this, they've got a very close ties with Nvidia. So they raised $700 million of funding through Nvidia Investing, and they are a reference platform cloud partner. So really, if GPU shortages become an issue again in the supply chain, and Nebius are invested in the company and are so tightly linked, you would still think they're going to get the preferential treatment, which sort of de-risks any supply chain risks that they may have in getting the GPUs delivered. They are also pursuing deals with AI research labs and tech firms. So if they start signing these as more buffer, really, and if they can keep them on a long-term contract, it'll just increase the annual recurring revenue, which is brilliant overall. So yeah, a key major contract in Microsoft, key partnership in Nvidia, and they are still chasing more AI companies and tech firms to get signed up to them. So that's very promising, and they clearly see a lot of room for growth still, even with these contracts signed. And signing a partner like this, it's good publicity for them, it's a good case study, and other big enterprise companies could be looking at them and think, well, if they're good enough for Microsoft, they're good enough for us. So yeah, that's very promising. Next up, we're going to run through the data centers that they currently have, the capacity, and the supply chain. So if we start with Kansas City, this was the first US availability zone, and this can be expanded up to 40 megawatts of power usage in the GPUs, and this is from 5 megawatts, so that can expand by nearly 8 times its current capacity, which is good. Next, we have the flagship data center, which is in Finland. So this has advanced cooling and waste heat reuse. There is 75 megawatts total power, or roughly 60,000 GPUs, so that is considerable capacity. It is ranked in the top 25 energy efficient supercomputers in the world, and it is used for their European customers. So yeah, quite a good flagship data center to have. Next up, we have Paris, which is the first facility with Nebius designed servers from day one. So that should hopefully be the most efficient if Nebius are running the most efficient data centers. And cool fact, the waste heat warms an urban rooftop farm. Yeah, I thought that was quite cool, so I just wanted to chuck that in there. Next, we have the New Jersey facility in Vineland, which is getting built for Microsoft. So this is going to have 300 megawatts of power once complete. So that is 4 times more the flagship store. That is 7.5 times the amount of power that the Kansas City one can deliver. So yeah, it's going to be huge, and this one is aimed at solely serving Microsoft, which I'm not surprised. They're going to need it. Next up, they have a data center in Israel, which is the company's first publicly available Blackwell chips infrastructure, and there is around 4,000 GPUs there. It is also going to be used by startup companies, universities, health companies in Israel, and I think the government are going to use it a little bit. Yeah, that's quite a positive one. And then they do have one opening up in London, which they announced in June. So this is going to have thousands of the Blackwell GPUs, which is what every company wants to use. And this is expected to be operational in Q4 of this year. So we're not far away at all. We're entering that quarter now. And it will support academics and public sectors like the NHS, as well as private companies. In terms of the supply chain, the GPU supply is a known bottleneck in the past. Currently, there's not a major issue with that supply, but like I've said previously, it's within Nvidia's best interest to supply Nebius with these GPUs. So yeah, overall, they've already got some really good data centers, and they are building more that have even more capacity. So really, they're in a really good position as long as they stick to the plan and they deliver that plan efficiently. So next, we're going to take a look at the competitive landscape and the market itself. It is considered a crowded field, and Nebius himself in their last report identified direct peers to them, and the 3 identified by Nebius were CoreWeave, Crusoe and Lambda. So these are seen as the 3 main competitors to Nebius in their eyes. They also identified indirect competitors, and these are the big ones. So this is Amazon Web Services, Azure, Google Cloud and Oracle. Obviously, they are all building their own data centers and AI infrastructure, but that is mainly for their own use. And obviously, smaller companies are not going to have the money to do that, or even the capacity. So I think that's why they're considered more of an indirect competitor. And now there's crypto miners which are now transitioning to providing more competition. And these are the likes of your Iron and your Hive. So these already have the setup there, and that setup is mining cryptocurrencies, and they're now transitioning some of that infrastructure to become AI infrastructure and data centers. So they're going to have to keep an eye on them as well. The likes of my last video where I compared Nebius and Iron, it was quite interesting to see, and I think Iron is geared up well to do a good transition, but we'll have to wait and see how much of that market share that they can capitalize on. The market size itself, global demand for GPU and AI is enormous, and this is growing. But something to note here is that experts can't seem to agree on their estimations for the market size. So by 2030, we've had estimations of 35 billion market size all the way up to 5.2 trillion. Obviously that is a massive window. So yeah, it's a hard one to predict because it's booming, and it's booming right now, and a lot of companies are seeing the value out of AI, which is why all the money's being pumped into it. Whether that's going to start slowing down and actually not utilize as much as people first thought, we will have to wait and let that play out. But yeah, that just shows the scale of what this market can grow to, and obviously Nebius right now we're in a prime position to start capitalizing on that and to grow into it even further. Next, we're going to look at the risks. So really there's the customer concentration is the first risk. Microsoft is that big first deal, and they must deliver or lose a big revenue stream, and they need to start broadening their customers really, because if they've got all this concentration and revenue solely coming from one customer, that's not healthy, and they could lose that at any point. So they really need to try and diversify that customer range a bit more. Geopolitical is a possible risk. So they've obviously got historical ties to Russia, and US-China tensions could impact the ability to secure hardware for the GPUs. So we've got to really keep an eye on that. Trump and Xi are constantly in a tariff war. Thought it had ended at start again. He's meant to be meeting them next week, so we'll see what happens, but that is a risk to keep an eye on. Which leads on to GPU supply. There have been industry-wide shortages in the past, so really if that happens again, they may struggle to deliver on the capital spending plan because they won't be able to get the GPUs that they were wanting. But this is sort of mitigated by that Nvidia partnership I mentioned earlier, so hopefully there should be absolutely zero issues. The next risk, which is one of the big ones, is the capital intensity of their business. They will continue to burn cash, and that will happen for some time. If they cannot convert this capital into customers, they may have to receive further funding, which will be required, and this could lead to dilution, which has been warned in the 20F filings, so that is one to keep note of. This then leads on to an execution risk. Any delays could defer revenue. Project overruns or power delivery issues could raise the costs really, and that will lower the margins. But so far milestones have been hit, but risk remains. So although they've got a good track record, you can't always take the past as future guidance. Same with stocks. Finally, it's competitive pressure. If prices fall, margins could face pressure. Customers may build their own clusters, or they may go to other suppliers, and technological shifts could also alter demand. So really, I just think the competitive environment is ramping up a little bit. All the other big players in the market are spending a lot to deliver a lot, and we also have people transitioning from crypto data mining into AI infrastructure. So for me, they're the key risks that I can highlight for Nebius. But to be honest, a lot of these are just key risks for any company in the market at the minute. But yeah, definitely got to keep an eye on them. And right now we're going to jump into a short clip from Jaysinvestments, who you can find below, that is also heavily invested in Nebius. And he's going to explain to you why he is invested in the stock. And he is heavily invested, and he might pick up on something that I may have missed. So I've asked him for a little opinion himself. So go check him out below. He makes great content. And yeah, enjoy Jay's little insight.
Hello, my name is Jamie, and I'm from Jay's Finance. I'm just going to do a little segment for John for his video about Nebius. So I'm going to run over a couple pros and cons about what I know about this stock. So Nebius, I was buying back when it was 18 a share. So I've held this for a while. I think it's a fantastic company and it's grown a lot. I also did my own videos earlier in the year of an overlook of the earnings reports and stuff. And I did think my targets was 80 by end of year. So we definitely surpassed that, but I didn't see the Microsoft deal being factored in. So some great things about Nebius that we need to take on board is the growth rate. Every earning so far, the AIR has been upgraded, which is the annual run rate. So they wanted to be at 1 billion, and by end of year, they plan to be by 1.1 billion. So that the growth rate alone is fantastic. It is something that is important for them to keep doing and to keep going forward on. So the cash, when Nebius was in its early days, still building out, they've always had a lot of cash on the balance sheet, which is obviously from the Yandex sale. So RKD has always had a lot of cash to dispense of, and I think that's very important in the data center plays. And they've also raised a lot of capital as well, which is great. So when they started this build out, they had next to no debt. They do obviously have debt now, but it's very, very minimal to what some of the data center plays and the Bitcoin miners have actually now got on their sheet. So that is a really good plus. The assets that they've got is phenomenal. So you've got ClickHouse, you've got Toloka, you've got a lot of the assets. ClickHouse is probably one of their biggest assets. Eventually, do we see them selling it off? Probably, more than likely. I mean, the worth of what it was to what it is now is incredible. They've made a lot of money on it. So eventually they are going to have to use that capital. Who knows? Do they hold it for a long term? But there's a lot of money there that could be used for more data centers, because there's 3 green sites that they were speaking on acquiring over the next 12 months, which is massive. So deals, Microsoft was absolute huge one, but in the space that we're in at the moment, data centers on a high demand. So do we see an OpenAI contract? Do we see another big person like that come in? Again, very essential. The Microsoft deal, I think people aren't really understanding exactly what that means for Nebius. It's the deal alone is nearly the same as the market cap, which is crazy. So that's a lot of growth that's going to be able to go into there. And remember, we wasn't that far away from where we are before we attained that deal. So yes, we jumped up a bit, but it wasn't. I think there's a lot more to go within that deal. 100%. Optimization is very, very important, which is a pro. They've got to make sure that they stay on top of the game, make sure they stay optimistic, make sure they stay optimizing everything, and but one thing I like about Nebius a lot is they have found ways to use older tech to get just as good value out of, whilst also implementing new tech, which is win-win. Means margin rates are through the roof. And one thing that's really great about Nebius is Trump recently said about that Nvidia would have to supply American companies first. The great thing about Nebius is they're on a gold list with Nvidia, and there has been releases since that those guys will be getting just as much chips as the American places. So that's amazing. Now, obviously, as much as people like to talk about the good, it's very important that we talk about the cons also. Now, with data center plays, it's very, very, very important that they keep up with targets. It's very important that they keep growing and they don't get stagnant. As soon as they get stagnant, some of these share prices are going to fall. And a lot of the data center players are really going through the roof, but eventually some of those aren't going to make it. There's going to be some that excel and some that really don't. So it's very important for Nebius to make sure that they keep hitting their targets and they keep growing into everything that they say each earnings. But I'm very optimistic they will. I think they're a great company. And lastly, margins is very important. We've seen a few data centers reporting earnings, and some of the struggles that they had was margins on rented tech. Obviously, Nebius doesn't have that problem, so it's very important that they keep up their margins, and their margins have always been really healthy. That helped.
So in conclusion, I think Nebius is a great stock personally, and that is why I'm invested. It has its risks, and you need to be aware of them risks when you are investing. Please go and do your own research if you are thinking about investing. But they're geared up for high growth. They're geared up to expand into what they are currently offering and deliver more for customers. They are starting to sign those big enterprise contracts, and as you've heard, they are opening data centers quite frequently, and the plan is to keep on opening more. So really, I think they're in the best position in the data AI infrastructure to grow the biggest. It'll be interesting to see how the market does grow over the next few years and how it operates and who does it well, who does it worse. But yeah, I think they're a great stock personally, and I'm happy to have them in my portfolio. If you have enjoyed this video, please leave a like. If you have missed anything, please put it below. Share that information with everyone, and we can just let the community know what a great stock it is. Subscribe for more videos like this, and I will see you in the next one.